Where should you be putting your investment money? Should you be using a mutual fund? What about an index fund? How about ETFs? Today we're going to discuss some investment options, specifically funds. We're going to talk about what they are, the differences between them, and which of them is the best. So if you're interested in any of that, keep watching. Welcome back to the channel. Please remember to hit that like button. If you're new here, hit that subscribe button and notification bell so you don't miss any of our videos. I'm Chima, one half of the Asika Bros, and today we're talking about funds. Let's start chronologically with mutual funds. Mutual funds have been around the longest, and I mean for a while. Earliest ones date back to the 1800s, and it was just a way for people to pool their money together and make more money. So how did they work? One of the strongest selling points, and there's a sale here, but more on that later, is convenience. You can have hundreds of stocks in mutual funds. In fact, I think for most it's more than 90, usually in the hundreds. Mutual funds give you instant ownership of all of these companies without you having to go out and purchase each one. This gives you the second selling point when it comes to mutual funds, and that's diversification. Mutual funds reduce your risk by spreading your investments in many different stocks so that you basically don't have to put all of your eggs in one basket. So if you keep that in mind, typically with 100 or more companies, there's bound to be diversification, and that's typically a good way to manage your money. This brings us to the third big feature of a mutual fund, and that's access to professional money managers. These managers are people who know what they're doing and generally get paid to pick your investments for you. Now, you may be thinking, wow, mutual funds are convenient, they offer diversification, and they have professionals who will manage my account for me. Sounds like there's no downsides. And dare you to be wrong, because mutual funds charge fees, and this is called active management. Active management mutual funds typically charge 1% to 2% per year. So let's just say that you're investing $10,000, 200 of that goes to the fund manager. And you can even lose money because fund managers get paid whether the fund performs well or not. It's possible that a poor investment decision, along with fees, could cause your account balance to just continually go down. These funds can be professionally managed in different ways. You see, there are load funds, and then there are no load funds, which essentially means commission versus no commission. But trust me, all of these have maintenance fees. So when it comes to mutual funds, it's not a matter of do they have fees, it's a matter of how much are they, and that's why it's important to look at the expense ratio if you're looking into mutual funds. If you look at the average for 10 years and find out how many fees you'll accrue, this is called the average annual expense. Mutual funds already have to report this by federal law. So you may be thinking that non-commission funds would actually be more expensive year over year, but that's not necessarily true. Your expense ratio could actually be cheaper with a load fund, and here's how that works. Let's just say a no-load fund charges you an annual maintenance fee of, let's say, 2%. Well, that would mean over the course of 10 years, the average annual fee is 2%. Now, with a load fund, they may charge you, let's say, 5% upfront. And it may seem like you're paying a premium, but however, they may charge lower maintenance fees, let's just say 0.5 or 0.6%. So it would be actually cheaper over the course of 10 years if you do the math that way. Moving on, then came the index fund in the 1970s. Index funds revolutionized the way we invest and revolutionized the investing landscape. An index fund is a portfolio of stocks that's meant to be representative of the market. It's a mutual fund, but there are several key differences than what we talked about prior, and one of them is a very attractive feature, and that's that index funds can be passively managed. What that means is the fund follows a fixed formula that removes the need for a person to make any buying or selling decisions. You've probably heard of index funds before. In fact, there are several different types of index funds. Maybe you've heard of the S&P, Standard & Poor's. They do ratings and research for the top 500 companies in the United States. Think of the S&P as a baseline. If you ever heard someone say that something is beating the market, this is typically what they mean. If it's above the S&P, then it's overperforming the market, and if it's under the S&P, then it's underperforming the market. So in the case of mutual funds that we spoke about earlier, lots of mutual funds actually underperform the market, but there are plenty that overperform the market as well. Now, the Dow Jones is an index fund like the S&P, but it tracks the stock price of the 30 biggest American companies. There's even index funds that mirror international markets. There are funds that mirror the S&P that I touched on earlier and that still offer very low expense ratios. So let's look at the Vanguard 500 index fund, for example. They charge as little as 0.04%. You heard me right. 0.04%. And if you read the product summary, it reads, as the industry's first index fund for individual investors, the 500 index fund is a low-cost way to gain diversified exposure to the US equity market. The fund offers exposure to 500 of the largest US companies, which span many different industries and account for 3/4 of the US stock market's value. Sounds pretty attractive, even with the minimum investment of $3,000. For this one at least. Now, the last point on index funds that I thought was important to note is that all index funds are mutual funds, but not all mutual funds are index funds. It's the same way how all apples are fruit, but not all fruit are apples. Just imagine if that was the case though, like in some alternate dimension, every fruit was an apple. It's pretty late as I'm recording this, clearly. Now, last but definitely not least, ETFs, or exchange traded funds. Introduced about 15 years after the first index fund, an ETF acts very similar to an actual stock. You see, with an index fund, you can only buy and sell shares once a day, whereas with an ETF, you can buy and sell whenever the stock market is open. Don't think of an ETF as a stock though, because it's not. But you can only trade ETFs when the stock market is open. You can even have more specific ETFs geared towards a particular sector or an industry. For example, I have cannabis ETFs, I have solar ETFs, semiconductor ETFs. Honestly, I can go on and on about this. So if you're interested in a video on just ETFs that I recommend, just leave a comment below the like button. Now that you know the differences between these funds, you may be wondering, well, which one is the best? And the answer is, it kind of depends. You see, while I personally love ETFs, I do think for some people it encourages impulsive buying and selling, because look at the way it behaves. It behaves like a stock. You kind of watch it go up and down. So it really just depends on you. I think that index funds are probably the easiest way for most people to invest in a fund. You know, you could just buy and hold, and then you just sell it when you're ready to retire. Another benefit of index funds is that they offer automatic reinvestments. So ETFs do not inherently offer automatic reinvestments, but depending on your brokerage that you use to purchase them, like let's say you use Robinhood that offers this, linked in the description, you can sign up for Robinhood, get one free stock, but it really just depends on you. So basically it comes down to this. If you're one of those people who you're somewhat impulsive, you don't really think you can fight the urge to not sell if you're actively watching, I would stay away from ETFs. However, for me, I'm an ETF man, but I also have money in index funds. Also, if you have a specific sector that you would want to invest in and generally have a good understanding of the market, then both ETFs and index funds are good options. But if you'd rather a professional manage your portfolio and you're okay with paying someone to actively do that, then perhaps mutual funds are right for you. Well, that about wraps this video up. I hope you guys enjoyed the video. Make sure to smash the like button and hit the subscribe button if you're new here, and the notification bell so you don't miss any of our videos. This has been Chima, one half of the Asika Bros, and I'll see you on the next one.